Okay, hello everyone. Welcome back. Today, I'm sorry that I'm out for the afternoon. I'm sitting in on some important interviews for new math teachers for next year, which is pretty cool. But for now, I do have some notes and some practice problems for you for the topic of tax deductions versus tax credits. These two words are often thrown around and can be misinterpreted or misunderstood, especially if you've never had to file tax deductions or use tax credits. And there is a very important difference, but filing, or rather applying tax credits or tax deductions, may be the most satisfying part of preparing a tax return, of actually filing your taxes. Because the goal of both of these things, using them, will reduce your tax bill in very different ways, but it will reduce your taxes. Okay, so I have some notes here. My version is filled in, but the version I posted on Google Classroom is there for you to fill in. After we complete the notes, there are some practice problems that I have for you, and those are printed out on paper for you to complete. Next class, we will go over them, but it's best to try your best this period so that you best understand how tax credits versus tax deductions can save you money on taxes. For now, though, let's just complete the actual notes. Tax credits directly reduce the amount of tax you owe, giving you what's known as a dollar for dollar reduction of your tax liability. A tax credit valued at $1,000 lowers your tax bill by $1,000. Now, what that means is if you owe $1,000 in taxes, but you have tax credits of $1,000, you will pay no taxes. Pretty cool. However, there's a slight caveat because not all tax credits are what we call refundable. Refundable tax credits can be applied to a refund, whereas non-refundable tax credits cannot. They will not count towards refund. So what that means is I'm just going to write a little example over here on the right side of the page. Feel free to jot this down as well, but it's not necessary. So if I owe $1,000 in taxes, that's how much I owe. That's my tax bill currently. But if I have $1,000, $1,500 in tax credits, then I'm going to have a $500 refund. That's pretty good. And obviously very good for me because I get $500. That's a refundable tax credit. If I have more refundable tax credits than my tax bill, I will get a refund. But for a non-refundable tax credits, if I have the same amount, but they're non-refundable, my tax bill is actually just going to be zero. You're like, what? That doesn't make any sense. Because these cannot be redeemed for a refund. They can only take down your bill to zero. Okay? They cannot give you a refund, but they will take it down to zero, which is obviously still better than the $1,000. But they cannot give you a refund. Right? So those are tax credits in a nutshell. Tax deductions, on the other hand, reduce the amount or how much of your income is subject to taxes. Deductions lower your taxable income by the percentage of your highest federal income tax bracket. So, what that means is tax deductions don't directly reduce the amount of taxes that you pay, but rather reduce your income, therefore, reducing the amount of taxes you pay. If you have a less income, you'll pay less in taxes. That's pretty much the principle of how tax deductions work. Let's look at some common examples of tax credits. First is called an earned income tax credit, often known as an EITC. This credit is available for low to moderate income individuals and families. It is a refundable tax credit. This means if your income is within a certain bracket, you are eligible for this tax credit to reduce your taxes because the government has evaluated that your income is low enough to do so. Second one is a child tax credit, a credit for parents or guardians for each qualifying child under the age of 17. And the TCJA, the Tax Cuts and Jobs Act, expanded this credit, and it is a non-refundable tax credit. So what this means is, if you have children, you are eligible for a reduction in your taxes through this tax credit. However, the fact that it's non-refundable means you can't just have or take care of millions of children and make a bunch of money through refunds and taxes. It will only take your tax bill down to, as we said before, zero. That's a non-refundable tax credit. After that, you also have the AOTC, the American Opportunity Tax Credit. It helps with expenses for higher education, and it is a refundable tax credit. It's available for the first 4 years of your post-secondary education. I'd recommend, if you're going to college, to look into that to see if you are able to receive that tax credit. The last one, child independent care, similar to child tax credit, but a little different, more focusing on the dependent part. It helps with the cost of child care or caring for a disabled spouse or dependent. Remember, dependent, yes, could mean child, but also could mean an elderly parent or grandparent that's living with you, and you're providing for over 50% of their needs. Additionally, it helps with the cost of taking care of these individuals, enabling you to look for work or to actually work. This is a non-refundable tax credit. So those are common types of tax credits. Those are not all the different types of tax credits. There are many others that you could potentially be eligible for. But let's move on to tax deductions. Tax deductions, on the other hand, once again, simply reduce the amount of income that you owe taxes on. Not directly reducing the amount of taxes you owe. There are different types of tax deductions, and the one we actually already know about is the standard deduction. We applied the standard deduction during our taxes project when we filled out a 1040 form. We know that someone who is single, the tax deduction is that magical number, the $13,850. That directly decreases your taxable income by that amount. And in formal terms, what does that mean? It's a set amount that taxpayers can deduct from their income without having to itemize deduction. We'll talk about what that means in just a second. It can, however, be different if you are filing as a married individual, or filing with your spouse, filing jointly, or filing separately. That is a different amount as well. But we know that for a single individual, it is $13,850. Okay, that's a standard deduction. Everyone is eligible for the standard deduction. Itemized deductions, on the other hand, taxpayers, us, can choose to itemize deductions instead of taking the standard deduction. It's important to note that if you decide to go this route, the itemized deductions, you cannot take the standard deduction. So you can't double dip, essentially. So they can choose to itemize them if their eligible expenses exceed the standard deduction. Okay, so if your itemized deductions exceed the standard deduction, why would you not take the itemized deduction? Okay. Common itemized deductions include the following: mortgage interest deduction for interest paid on mortgage loans used to buy, build, or improve a primary or secondary residence. So secondary residence, a primary residence, that's where you live most of the time. A secondary residence could include something like a vacation home or a lake house, something along the lines of that. Second one, state and local taxes. SALT is a deduction for state and local income taxes or sales taxes and property taxes paid during the tax year. Basically, what this is saying is that you can deduct the state and local taxes because they theoretically should not affect the amount of federal income tax you would owe. And the last one we're talking about on this side of the page, charitable contributions, deductions for donations made to qualified charitable organizations. This could mean you're making a donation to any organization that's charitable, such as the American Rescue League, Red Cross, or something as simple as your weekly donation or tithe at a church. So those are common tax deductions. However, the most common type of tax deduction, which most people probably think of, are business expenses, which we'll get to in just a second. Because I forgot that we are also eligible to deduct certain medical expenses that exceed a certain percent of your adjusted gross income. So, what this means is that if your medical expenses for a certain endeavor or throughout the year exceed a certain amount of your income, then you are eligible to deduct them from your taxes. Those are medical expense deductions. And it's based on your AGI, your adjusted gross income. But now, I jumped the gun a little bit, but now I can tell you the most common type of deductions that people probably think of, besides the standard deduction, are business expenses. You may have heard an individual who owns their own business bragging about all the deductions that they can take off of their taxes. Meaning, oh, well, I bought a computer for my own business. Really, I just use it for myself, but I can deduct it from my taxes. Or I'm a personal trainer, and so I bought all this gym equipment that I'm going to use for my personal training business. I deducted it from my taxes. However, at the same time, they're probably the ones most using that equipment or that computer or whatever it might be. But there are a lot of things that are eligible as deductions for business expenses. Operating expenses include things like office and business supplies, utilities, rent, insurance, repairs and maintenance to your building, professional services, advertising and marketing, travel expenses, and business meals. All this stuff, if you keep your accurate records, which is very important, you must maintain accurate records of these things, you are eligible to deduct them from your taxes, reducing your income and therefore reducing your taxes. But things such as employee expenses are also eligible to be deducted from your taxes. Salaries and wages, employee benefits, payroll taxes, employee training and education, and employee travel expenses are all things that are eligible to fit under business expenses that you could deduct from your taxes. To itemize your deductions, I did link a form that you can follow on the IRS website. Is Schedule A. You would attach this to your 1040 when you submit your taxes if you were doing it by paper. If you did it online, you'd have to fill it out online. Now, to further demonstrate the difference between a tax deduction versus a tax credit, there's this table here. It's very helpful. It shows you when and how tax credits versus tax deductions are actually applied. We are going to assume that we're either eligible for a $10,000 tax deduction or a $10,000 tax credit. We'll see the differences. We'll assume that our income is both $100,000 for both of these scenarios. Man, I wish my adjusted income was $100,000. But anyway, if I have a $10,000 tax deduction, that is going to be applied directly to reduce my income to $90,000. So if I have $10,000 tax reduction, I subtract $10,000 from my $100,000 adjusted gross income, AGI. And so now my taxable income is $90,000. And that's a sweet deal because I no longer have to pay taxes on that $10,000. We'll assume our tax rate is 25%. That'll stay the same as well. And so 25% of 90,000 is $22,500. So it would save you a little bit in taxes because 25% of 100,000 is actually 25,000. So we would save ourselves about $2,500 in taxes, which is pretty good. That's $2,500 that you have instead of the government. On the other hand, if we have a tax credit of $10,000, nothing changes about our income. That stays the same. So our taxable income is just whatever we made. We apply the 25% tax rate, and so our calculated tax is $25,000 because that's 25% of $10,000. But here's where a tax credit is really, really nice. If we have $10,000 in tax credits, which is a lot, it would directly decrease the amount of tax that we owe by $10,000. And therefore, we would only owe $15,000 compared to $25,000 in taxes. So as you can see here, tax credit versus tax deduction can be very different